Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday morning in the UK, evening in Australia on October 30th, and we're delighted to be joined today by Michael Blayney. Welcome, Michael. Thank you for joining us here for a discussion.
Thanks very much, Ethan. My pleasure to be here.
Well, let's move on and let me bring up the slides. I've called this today's discussion a sting in the tail, as we're moving on from the cockroach analogy to have a scorpion analogy. The sting in the tail in this case is the sting in the tail of AI, which is the job cuts that we've heard being discussed and forecast as well. So this is a little bit of the flip side of an otherwise positive equity story, and we'll be discussing that as we move through. As usual, we talk about inflation, interest rates, equity markets, geopolitics, and other asset classes, and like to translate that into what it means for your portfolio. We have a few sub currents of discussion here. We'll look at inflation, whether it has surprised on the upside, is staying sticky. We'll look at rates easing clearly with the latest Fed decision. We look at corporates staying nimble, which may be a euphemism for cutting jobs, and they seem to be getting rewarded for that today, particularly in the US. We'll speak about the market, whether it is continuing to melt up and whether there are any signs of concern there. And as always, bring it back to portfolio implications. So here's our guest, Michael Blayney. He's General Manager, Dynamic Asset Allocation at Hesta, an Australian superannuation fund with over 100 billion in Australian dollars in assets under management. Welcome, Michael, again. Great to have you here and looking forward to hearing your insights.
Great. Thanks very much, Ethan.
Well, let's kick right off and go into inflation. So this is obviously a topic that is not going away, literally or metaphorically, in the sense that we now have a kind of hovering in the US, at least around a 3% target. It says that headline inflation is rising again and services are slightly down. And as always, the mix of that, services now represent the bulk of the inflation number. We have heard that the Fed is data dependent, so highly focused on both this number and the jobs number. I think a slight problem is that the data is now getting a little murkier, if for no other reason, because we've had the government shutdown and a delay in some of the outputs. But as food remains persistent, energy has moved around with the fall in the oil price, but services certainly the staple there. And there is a sense that is 3% the new 2%, given that we've seemed to be unable to get closer to that 2% level. So this is going to press on the Fed. It's definitely going to press on the consumer. I'd love to pass it back to Michael now in terms of the inflation number in Australia. What are you seeing down there? And are there any similar indicators?
Yeah, so we're very similar. We're around that sort of a sticky three number as well, and we just had inflation surprise on the upside, which has caused people to reassess the likelihood of another cut from the Reserve Bank of Australia. I think it's quite interesting that we're seeing this backdrop even during a period where oil prices have been relatively stable and not that high. And so you're seeing inflation in spite of that, which was, often, is a cause of the spikes in inflation. And, also we're not really seeing that sort of goods deflation. And we haven't even felt the impact of the tariffs yet too much with the inflation. I think if anything, we're surprising a bit on the downside compared to where we are. So certainly shorter term, there's real pressure on the upper end of that bound.
It's really interesting because I know affordability has been top of mind for many Australians and certainly headlines, particularly around the housing market. And just in terms of this inflation number, so how would you say that is affecting the consumer when it comes to whether it's the lower end consumer or every consumer in terms of their spending power and how it contributes to the resilience of the Australian economy? Do you think they are feeling the pinch?
Definitely. Cost of living is definitely topical here. We also have one of the most expensive housing markets in the world. So a very large proportion of people's income goes to, either rental or paying off a very large mortgage. And so that I think has been, well, whilst it's been an area of wealth creation for those that have been in the property market. It's clearly a major impact on people's disposable income. And when you add to that, inflation at the grocery store or in the power bills, then obviously people start to really feel the pinch.
It's really interesting, and of course, the services and the components of that, as they factor in, vary. Of course, depending. Do you find that services are also the largest portion down in Australia?
Yeah, look, I think that's fair. When the inflation surprised on the upside, it was kind of the feedback was that it was pretty much across the board, the upside surprise. So it is quite strong. And I think there's a couple of longer term factors though that we also need to think about is that you've got the potential, whilst we are talking about inflation right now, there is the potential for long-term deflationary impacts from artificial intelligence. If we see the sorts of job losses come through that people might in a worst case scenario forecast. You could see some real demand destruction. You could also see, and again, whether that flows through to lower prices or to higher corporate profit margins or a combination of the two, some real downward deflationary pressure from AI. On the flip side, though, we do live in a world of heightened geopolitical risk. And we know that, geopolitical events, and we saw that with the invasion of Ukraine, that can cause a sudden upward spike in the prices of key commodities that can flow through to inflation as well. So it's a really murky long-term outlook for inflation as well, with sort of those competing forces, and we still need to decarbonize as well, and that's expensive. So there's some real long-term forces at play that are working against each other.
And how much of a factor is it in your asset allocation at Hesta, the inflationary piece? How much of your portfolio do you seek to build in inflation resilience, and how do you do that with which asset classes?
Yeah, so we in Australia, most of the superannuation funds are what's called defined contribution. So we're not paying, fixed pensions per se or CPI indexed pensions. It's very much the accumulation of members' contributions that they then turn into either take as a lump sum or turn into a retirement income stream. Um, with that in mind, ourselves, like pretty much every other superannuation fund, have an inflation plus return objective for our default options and our other options as well. So it's really important for us to be able to preserve and grow the purchasing power of our members' retirement savings. In terms of inflation hedges, the most direct way to do that is through an instrument called a zero coupon inflation swap, which is basically an instrument where you pay a fixed rate of inflation and then you get paid a variable rate of inflation depending on what's realized. And that's a good instrument for investors who want pure inflation hedging. It is more of a institutional instrument rather than necessarily one that's readily available. I know instruments that are readily available to sort of your average investor with a small balance directly would be things like TIPS, in inflation index bonds, and those can be very useful for hedging inflation as well. And we certainly do own some in Australian inflation-linked bonds as well. I guess the main issue with those is that when you see a rise in real yields, in real interest rates, you can still see some shorter term mark-to-market losses on those in the same way that you do with a nominal bond. So they'll protect you from inflation over the long term because the coupons that you receive and the final balance that you receive on maturity is indexed with inflation, but you can have some mark-to-market losses along the way. So hedging inflation is a very difficult thing to do if for a superannuation fund or indeed any institutional investor, because often when you do see an inflation shock, like in 2022, and indeed when people were even scared about it back in 1994, those were the years when both equities and bonds fell together. And it's a very, very difficult environment because it's an environment where your key diversifier is not really working. Um, you can, of course, invest in things like real assets, and we do have a meaningful portfolio of things like infrastructure that have long-dated inflation-linked cash flows. Also property, whilst property, obviously, particularly office, has had its challenges, nonetheless, property is still a good long-term inflation hedge. And so some of those style of assets can be quite good, as well as actively managing our duration risk through time to try and smooth out the outcomes to members a bit.
Well, that's a masterclass in inflation protection or resilience there. I think you noted rightly how difficult the actual hedging piece exactly
Mm,
is. Move on to fixed income now, because obviously you drew
mm,
the line between inflation numbers and the central bank. And we look here at the bond. We've spoken before about the bond yields coming down, how the markets seem to be buoyant and maybe underpricing risk. This is in the US around sovereign bonds and corporate bonds. We have just had the Fed decision in the last day, and there was quite a lot of rhetoric around that decision, a discussion around the driving in the fog and needing to go slowly, a caution about markets getting ahead of themselves, expecting perhaps more rates. We know that Stephen Moran had elected for a 50 basis point rate cut. The ultimate decision was a 25% rate cut, but also a discussion around the jobs numbers and perhaps seeing the weakness there because the ostensible strength in the job numbers could have been affected on the supply side by a lower participation rate, as well as simply the immigration factor affecting the workforce. So a concern about jobs and seeming to be top of mind for the Fed. However, we also see that this the bond market seems to be quite buoyant. So I suppose it'd be interesting to get your take on the rate trajectory here. Are we heading down, at least in the US, and maybe Australia's on hold because of their inflation numbers? And how do you reconcile this downward trajectory with an ostensible strong economy? Or do you think the job numbers are in fact weak, as the Fed suggests?
Well, I think it's a really interesting conundrum we have right now. I mean, there's also the issue, of course, in the US of fiscal sustainability and the size of the deficits. That's one which we fortunately don't have in Australia. Our debt to GDP ratio is substantially less than the US, and so the main spillover that we get from fiscal sustainability is just that if US yields go up, ours tend to follow the next morning when we wake up. But certainly the market didn't like it. You'd call that almost a hawkish cut. You saw US 10-year bond yields up almost 10 basis points last night on that. I think it's really interesting because we're likely to see a more sort of low interest rate friendly Fed next year as you see a bit of a changing in the guard. So we may see an environment in which we actually have lower short-term rates but a steeper yield curve. If there's a genuine concern about the fiscal sustainability, but at the same time a desire to keep rates lower to stimulate employment. And I think with the large debt, there's a real incentive to run the economy a bit hot, to have high nominal GDP growth, because ultimately, that will help at least with keeping the overall debt to GDP under control to some degree. But I think there's something interesting there as well around, what people are paying for, high yield bonds. You've put some emerging market bonds on there as well. Some, triple B rated corporates, so your lower rungs of investment grade bonds as well. And the spreads which are the extra compensation that investors ask for over and above a government, what you would call a risk-free asset, you and I. But is incredibly low. And so, bond spreads are supposed to compensate investors for the risk of default and for, liquidity, particularly when markets get stressed. Generally, credit gets less liquid, and you need some degree of compensation in the spread for that. And you're just not being paid a lot to take on that risk right now, as your charts show. So we've seen a real melt up across all the risky assets, and against that backdrop, even with the fiscal sustainability, bonds kind of maybe look okay, but not exciting.
Well, definitely that word melt up is something we've used in connection with equity markets as well. And it is
Yeah.
interesting, as you mentioned, because the fixed income markets tend to be maybe the worry warts. They tend to be the ones that would maybe be more pessimistic in terms of the hope story. Yet they're not. They seem to be underpricing risk unless they're reserving that concern for the private credit market. We can talk about that in a minute, but it could be that in the listed fixed income market, or the public fixed income market, we don't have those concerns. These are some equity market charts, just moving to equity markets, and it has been nothing but a surge since in the last few weeks. New records being breached. And of course, the concentration that has been a factor now for many months, continuing as Nvidia has now breached the 5 trillion barrier as a market cap. And I saw a chart yesterday suggesting that this now is greater than the entire market cap of all UK public companies, as well as Singapore thrown in for good measure. So clearly, in a new good paradigm in terms of these very large companies and just the sheer size of their market cap, and the S&P itself pushing closer to a 7,000 milestone. Of course, there is that old adage that the stock market is not the economy. And we've already raised some concerns about some, perhaps cracks in the economy, but the stock market seems to be in rude health. And I'd love your thoughts on this kind of melt up in certainly the US equity markets and these really high market cap levels that we're getting with certain stocks. How do you navigate as a global allocator when a single company can dominate world markets in that way?
Well, it's a very difficult issue because, of course, at the end of the day, the US it's getting up to 70% of world indexes now. So it's a very critical part of the investment opportunity set. And, the AI boom is we can see it. We can see that there's some very real elements to this, and that it's something that every corporate has got to be thinking about how to incorporate it in their business, ourselves as investors, some of the investment managers we use, we're all on that AI journey with figuring out, well, how do we use this thing? How do we use this thing to become more productive? Now, having said all that, the US, the S&P 500 is on about a 26 times forward PE. Asset allocators with grey hair will know that that usually doesn't mean that you have a great outlook for prospective returns. And I think we always need to be very, very careful about rear window investing. But even in Australia, where we have a market that's dominated by, really four big banks and, a few resource companies and a few other sort of companies that operate in, duopoly, oligopoly type situations, we're trading on more than 20 times earnings. So there's a lot of enthusiasm out there. And, clearly, I think you get on later to the web of revenue between these companies, and that, at the end of the day, Nvidia's biggest customers are also other players within the Mag 7. And I think, there's a real question as to how this finishes up. And I think we also need a good degree of humility when we're thinking about this, because it's one where, if you think about professional stock pickers, who do that for a living, they've really struggled with this. It's not been a great environment for active management. A lot of active managers have been caught on the wrong side of this, and you've seen almost as even more money has moved from active into passive. That's even fueled the fire more, with even more capital being allocated to the largest stocks in the index. Ultimately, what we'll need to see is this massive capital expenditure turn into revenue. And I think if you think about this versus the last tech boom we had in the early 2000s, people do draw some of those comparisons, but then also differentiate themselves, because in the last tech boom, you didn't have the massive profitability that you do now. But nonetheless, I think for this to be sustainable, we're going to need to see this massive AI capital expenditure turn into earnings, and that get monetized, and some exogenous factor or some regulation or any sort of X factor not come along and upset the apple cart on that. But for now, I think from a diversified portfolio, you have to have exposure. It's just a matter of, how much exposure, how much do you want from a portfolio perspective? But we're long-term investors, so we're, staying the course with global equities and with the US market. We will at times, when markets get a bit expensive, hold a little bit less equities than usual, but we're not that those aren't massive swings. And I think, also I think the other thing that investors need to bear in mind is it's always very, very hard to pick the top. And in many ways, if you're disciplined, and when you do see volatility, we haven't really seen volatility since the volatility of April. We sort of went from extreme volatility to just sort of a very steady climb upwards. For investors, when they see those periods of volatility, having discipline and using that to top up holdings can be a really good way to add incremental returns as well.
And I think it's interesting that the word tangled is used here because I think, as you mentioned, it's very, very hard to parse what exactly is going on here. I think it's very quickly how quickly we've learned to doubt the veracity of any video we see now that AI video generation is so easy. And I think it's equally easy to doubt the veracity of some of the news we get out of this segment in particular. I compare it to the complexity of the 2008, 2009 financial sector when new instruments with new names that nobody understood. And there was this kind of, I think, this mystification perhaps of finance. I think it's something similar in AI. It's very hard to understand the language, the acronyms, the interrelationships. And perhaps for that reason, we can't detect the potential cracks or codependencies. So I don't think this issue, we finished discussing it in terms of stock market watchers. It will continue to roll. And as you mentioned, the need for diversification within equities is key, but sometimes it's harder to achieve when you have these very large dominant companies. In terms of the signs, so we talked about the S&P being at a peak. Clearly, there were the Nasdaq and the tech base of that driving things above a 200-day average. And then in terms of just some of the cross currents, we mentioned the sting of the tail at the very beginning. This was the Amazon announcement cutting 14,000 jobs. We know that UPS cut about over 30,000 jobs, and it seems that job cuts are now flavor of the month, and they're behind these staggering earnings that are really wooing and wowing markets. As the earnings have outperformed. If we look at the performance of chip makers, AMD, Qualcomm, Broadcom, Nvidia, despite its very strong performance, has actually underperformed them. So clearly that is the tide that is lifting all boats. And I thought it was an interesting chart here on the bottom right, which was produced by Ritholtz Wealth Management. And that's showing a gap between expectations and reality. So suggesting that with the blue line being market cap share, we've spoken before about the very large percentage of market cap the tech stocks are representing, but they don't have a commensurate share of net income. So we might expect that for tech stocks that their income would not always that we'd see just a different profile in terms of their growth phase. But I think it is still a sobering reminder that that these tech stocks are trading at valuations that are really getting into the stratosphere. And should we be again just mindful of this growing wave? I'd like to move to global markets now, given we have a global audience here on this call and also the presenters. So a couple of things to comment on. I presume, Michael, at Hesta, it's a global exposure you build, but mindful of the fact that the US dominates that. Interesting to see, I think that China has really moved in sync with the US very much this year. But it's been the strife between them that has generally led to chills in markets. The interesting point on the bottom right in terms of China and the US moving strongly this year is that both have a lot to lose if trade talks go awry. In that we know that markets don't like that. They're both trading at sort of high valuations. So I suppose given Australia and China have always had trading relationships and there's been a strong relationship with Asia overall, how do you think about the global diversification and perhaps the pathway of global markets as the US continues to dominate?
Yes, well, we've always, maintained some degree of emerging markets exposure, and of course, exposure to the non-US developed markets as well as part of our global portfolio. I think the US China tensions is really interesting from a geopolitical strategic perspective because there's clearly a desire to decouple. You see that with things like rare earths. Interestingly, Australia stands to potentially be a beneficiary of some of that. Equally, if those tensions get too bad, and we saw some of those tail outcomes, like, if we got a hot war, then Australia would obviously, suffer considerably from that. So there's kind of this path that we have between China being a very large trade partner and US, of course, being our key defense partner, for us to perverse, so to speak. But for some of the like middle powers who can potentially, be a friendly trading partner, to potentially, both, there is potential upside there. And I think, you know, non-US markets in general are a bit cheaper. Um, you know, Obviously we've seen strong markets everywhere, but generally from a lower base. So there are potential opportunities, and if we see, for example, more defence spending in Europe, then that has the potential to sort of, you see a loosening of some of that historic fiscal discipline in places like Germany and China specifically. Not many investors would probably access that through the local A shares. But certainly a lot of global investors would be accessing that through Hong Kong, through either, exposures that perhaps look like a bit like the Hang Seng, or, there's also the Hong Kong China Enterprises Index as well. There's a lot of, big quality tech names that global investors tend to like in those markets. You've got names like, not that I'm obviously recommending any stocks. I'm not a stock picker, but you do have the big names in the index like the Alibabas and Tencents of this world, which have very strong market positions. We're also seeing a huge number of IPOs into the Hong Kong market as well. There's a couple of hundred apparently, that are in the works, and quite a lot of capital raised as well. So, Hong Kong was one of those markets which traded perennially cheap. It often looked to be on a PE of 10, and we've seen some recovery there of late as well. So I think, for global investors, there's plenty of opportunities outside of the US. But I think it's just at the end of the day, the US is obviously the biggest, most liquid investable market there is. So you have to be there. But then it certainly makes sense to maintain that global diversification, and emerging markets are certainly part of that.
I think a good example of emerging markets is when we look at Argentina, just how much that has risen in the past few days as we've seen the success of Malay's party coming out of the election results there. I think it'd be great to just move now to some other segments of the market. It's interesting that the diversified asset managers, say the likes of Blackstone, Apollo, KKR, have not been participating in the recent rally, which is interesting. This is really, I think, is this a comment on the some of the murkiness that surrounds private assets at the moment? We've had a couple of, whether it's cockroaches in the coal mine at this point, or canaries in terms of the private credit health, although nothing systemic. We've seen some minor alarms, and we've also had that kind of nagging alarm about private equity not returning capital at the same pace and being under some pressure, certainly from a fundraising. So I think it's interesting that we've had, on the one hand, the euphoria around tech, but diversified financials actually underperforming on a year-to-date basis. I'd love to hear your thoughts on private assets, just very top level. I don't have much time, but also why is it reflecting in these diversified manager stocks? Do you think that the investor is more concerned perhaps than we think?
Well, I think, obviously private assets are not a particularly homogenous group. There's some areas like infrastructure assets, for example, infrastructure equity, where, we really, that's an asset class we really like. We have a very large exposure to that, and you get, largely, uh, economically less sensitive, inflation-linked long-term cash flows. It's a great place to be. I think there obviously have been issues raised with private credit. It's very hard to get a really good lens on it because it's private. So there simply isn't the data that you have on, the traded high yield market, or, one of those markets where you can actually see all the constituents. You can see their credit ratings, the spreads. It is very murky. We have seen some of those things where people have talked about auto loans, where the collateral's been driven across the border, and so it's hard to get a recovery on it. And so I think you're certainly likely to see, you know some issues with some private credit, but as you say, the question is whether it's systemic or isolated. But you're clearly seeing a bit of negative sentiment here and a bit of concern. You also see that with things like regional banks. Regional banks have been pretty weak as well and have been hit hard. So there is some of that. But again, it's sort of a lot of this stuff will depend on what policymakers then do, because we had the Silicon Valley bank crisis not that long ago. And even though obviously, some investors suffered from that, at the end of the day, the Fed kind of came in and got the broader contagion under control. So as long as people believe that there's that backstop to markets there, then it's less likely that something like this will break the market. But like all these things, it depends on how systemic it becomes. And at this stage, it's more something to watch rather than necessarily something that we would be overly panicked by.
But I think it is a kind of a good reminder that investors can have an appetite for euphoria, and they don't necessarily experience euphoria across the board. They can be
Yeah.
discerning in certain sectors. And while right now there doesn't seem to be a lot of that around AI and tech, they are, I think, being quite discriminating in terms of what stocks they're prepared to hold at the moment and where they show their concern, which is quite reassuring. I think we spoke about the global assets, and I won't return to that, but clearly, again, that's where there is the opportunity to get that concentration. I do think we have to think a little bit about what this concentrated market will look like, and how a diversified portfolio ultimately, say in the UK, for example, if the market cap is the same as Nvidia, you're going to get a much broader spread of equity market exposure across the entire UK public market than in a single stock. So that will probably affect how investors think about their portfolio. And then finally, I don't have any charts on it, but just I'd love to just talk for a minute, and for our last minute, about gold and the some of the other diversifiers. And how do you think at an asset allocation level about things like gold, Bitcoin, anything else? Is there space for that in a portfolio, or do you stick to the traditional asset classes and see those maybe as kind of as interesting touch points or sound bites in terms of investor sentiment?
It's fair to say at present we're a bit more traditional, rather than necessarily being in those areas. I think they're obviously a little bit different in that gold is your more traditional store of value. It's just hedge against geopolitical risk, and we've seen the gold price up a lot. We've also seen a huge amount of central banks diversifying their holdings, and a lot of demand coming from that area for gold. I think at the end of the day, though, gold doesn't offer you any sort of yield. So if you're buying gold, you're kind of either buying it because you think things are going to get really bad and that you need that store of value, or that you think that the price is going to appreciate further. But it's a difficult one to have sort of the same sort of metrics that you would on other financial assets. You're not going to have a yield. You're not going to have a fair value. The crypto is interesting. I think it's one which is getting a little bit more institutional acceptance. Obviously, there's a huge number of cryptos, but most of the market cap of crypto is still in Bitcoin. I think it's an area that will continue to be an area of research, but I think it's natural. It's natural given the extremely high volatility and the ability for new cryptos to be created out of sort of thin air and be printed and finish up with market caps in the billions, for institutional investors to naturally be a little bit wary of that. But nonetheless, got to keep an open mind and always looking on the lookout for new research ideas.
Exactly. I think this reference to R&D is exactly what I was thinking. We're operating in a laboratory, really, where we're working away with the asset classes that we know their characteristics and their properties. And when new elements come in, or old elements that start to act differently, like gold, perhaps, it's imperative to give it attention from a research standpoint as a discovery point. But yes, using them in the factory maybe it may be early days. Well, thank you so much, Michael, for sharing this broad-based insight into how you operate at Hesta, into the Australian economy and into how interconnected we all are, indeed discussing all of the same issues, but with slightly different application according to where we are in the world. Thank you for sharing your insights here.
Great. Thanks, Ethan. I really enjoyed the discussion with you today.
And
Appreciate
thank
it.
you,
Thanks for
everyone, for
having me
listening
on.
to the Markets Happy Hour podcast.